Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to the markets, investing, real estate, and everything as it relates to personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But in today's video, I want to talk about the news that I guess you could say has shaken the financial world, which is Warren Buffett and Berkshire Hathaway's $10 billion purchase of Dominion Energy's natural gas assets. But I also want to talk about how this sort of deal separates Warren Buffett from the vast majority of other investors, and also what we can still learn from it even at a lower position or with far less money than Warren Buffett has. But to recap the details of this deal, in case you're not as familiar yet, Berkshire Hathaway came in with $4 billion in cash and then assumed $5.5 billion or so of Dominion Energy's debt to then take hold of $10 billion or so worth of natural gas assets, including a lot of pipeline and also storage facilities. This also greatly increases Berkshire Hathaway's share of the natural gas industry in the U.S. Numbers I saw put it at close to 20% of the natural gas industry, up from about 8% before this deal. So much larger stake in natural gas, which obviously Berkshire Hathaway and its large energy subsidiary are certainly keen to look for opportunities in. And on the other end, Dominion Energy, I guess, is using a lot of this cash not to pay down any other debt it has, but instead to purchase its own shares in a share buyback program. Who knows why they wanted to do that, but it certainly has upset a lot of retail investors or those who have held Dominion stock who aren't on the board, who might not have incentives for bumping up earnings per share and all that sort of stuff by doing share buybacks to take shares out of the public circulation. It might not be the best business decision, but it might be the best decision for executives trying to boost pay in a lot of cases. I'll link a video, an excellent video that Joseph Carlson did a while back about share buyback programs and why he doesn't like them, but generally it goes over a lot of the problems with the incentive structures that companies have in giving their executives basically share metric based bonuses that really entice them to, as a company, buy their shares back to bump up artificially share price numbers and earnings per share numbers and all those sorts of metrics. But that's beside the point. Dominion can do whatever it wants with its cash. It sold off the asset. It now has the cash in its possession. It can do whatever it wants. That's on it. But what I really want to talk about is how Warren Buffett is in a drastically different position than you and I as retail investors, or even if you're a wealthier investor, how his level and Berkshire's level is so much different than basically everyone else. Now, for those of you who follow Warren Buffett, seems like a great idea. He's a very successful investor and has been successful for many decades now. For those of you who follow him, which is most of the financial world, frankly, you've probably noticed that he's held about $180 billion in cash and really hasn't done any major deals in the last few years, and definitely hasn't done any in the pandemic up to this point, besides his, we'll call it, failed venture in trying to buy a bunch of airline stock, only to then resell it just a couple months later when he and Berkshire decided that the airline industry was a no-go for the foreseeable future. But I mean, that was really a blip on the radar. It wasn't a gigantic deal, and he still has been sitting on all of this cash. He and the company have had so much cash to use and haven't done anything, and have started to get really scrutinized for it since people thought there was a ton of opportunity during the market dip in March, and Berkshire really didn't do a lot. But this is the sort of situation that he'd be waiting for. It's a type of deal that a normal investor really doesn't have access to. You and I don't have access to buy an entire portion of a multi-billion-dollar company's asset pool. We don't have the power or the leverage or the access to capital to go in and buy a giant company or even a portion of a giant company, unless we're talking about tiny couple $100 positions in a company, which you're not going to have any power on the board or really any power to change anything. But Berkshire Hathaway and Warren Buffett's portfolio really don't act as much like a typical investor anymore. They act more like a bank. They are a pseudo bank that can come in and bail out companies when they can get something out of it, which a bank might not be willing to do in many cases, a normal bank that is. But Warren Buffett and Berkshire Hathaway have all of this cash to where they are sort of a lender of last resort, or maybe even first resort, depending on the deal, where companies that might be in distress would struggle to get traditional financing and instead can go to someone like Warren Buffett, or maybe Warren Buffett would go to them, be like, can you please bail out this portion of our company? We'll give you a giant share. We'll give you a preferred stock with a hefty dividend, which he's done many times in the past. You and I don't have access to these sorts of private deals. I don't want to call them backdoor deals, but that's kind of what they are. These deals aren't available to the public because the public doesn't have this consolidated fund that can come in one foul swoop and bail out a company or give it the capital it needs to keep going or make a large change in its business. And Warren Buffett and Berkshire Hathaway know this. That's why they've been sitting on all this cash. Some of it is just to prevent a liquidity crisis because he has a lot of insurance businesses and you never know when you're going to need a lot of cash. So having some of it is just a security measure, but a lot of it is looking for these sorts of opportunities which you wouldn't have if they didn't have a ton of cash available. And I mean a lot of cash. Since they have enough cash to buy a lot of very large businesses if they wanted to, just if they decided that for whatever reason it became worth it. Now, obviously they don't think it's been worth it in recent years, but they are waiting for those sorts of opportunities that come in distressed times and in economic hardship when businesses might be threatening to go under. Berkshire Hathaway can swoop in, buy a ton of the stock or work out some sort of deal, some sort of debt arrangement, and then ta-da, Berkshire Hathaway has this great opportunity that wouldn't have been available if they didn't have the cash ready to go. And that's something that a lot of people don't really pay attention to when they criticize Warren Buffett for having all of this cash or for trying to pretend like they can actually act exactly like him. There are certainly some lessons that we can learn, which I'll get into shortly, but it's too simple to just say that, oh, Warren Buffett's silly for holding all this cash. I've made money in these stocks. Why doesn't he do that? He's a bad investor. He's lost his touch. We have to remember the opportunities that Warren Buffett has access to by having all this cash are completely off the charts compared to the opportunities that you and I might have access to. Warren Buffett can come in and take a large position in a large company and can make seismic changes in a company and can buy entire arms of a business like he just did with Dominion. We can't go and buy 20% of the natural gas market, but Warren Buffett can because he has a ton of cash and he can work these preferred share agreements that he has in the past. He has access to those deals that we don't have access to, and that's something that cannot be ignored when you're criticizing his giant pile of cash and wondering why he doesn't go for certain opportunities that you might think are good. Because the fact of the matter is, even though those opportunities might be good right now, the chances that Warren Buffett will have access to an even better deal just by waiting a little bit longer seem to be getting higher by the day given the tumultuous times we're in and the economic situation as it continues to sadly worsen in a lot of areas in the economy. But I want to get to the central lesson here and what we still can learn from Warren Buffett's position, and even though you and I might not have many billions of dollars of cash in the bank. Now, if you do, definitely let me know. I'm always looking for podcast guests, so I definitely would love to hear your story on how you got those billions of dollars in cash, since that would be an interesting topic. But anyways, since you probably don't have that amount of cash, you can still learn something from this, since Warren Buffett has basically taken a pretty simple principle and it's just brought it out to a gigantic scale. And that simple principle is opportunity cost. And the opportunity cost, when you get into the many billions of dollars, simply changes. As you acquire more and more cash at any level, the more cash you have, the more opportunities you'd have access to. Now, the more opportunities you'd be foregoing as you accumulate that cash, but ideally, those opportunities will get better and better as you get more cash and as you have more flexibility, since that's what cash is. Cash is financial flexibility. It's not an investment in itself. Often it actually loses value as time goes on. As I've covered many times on this channel before, the Fed's printing more money all the time, making each dollar bill worth less since there's more of them and no more value being created. But anyways, as you get more and more cash, you ideally have more opportunities. And those opportunities are valuable. And because you have those opportunities available, or maybe not in this instant, but might have them available soon enough, you have the opportunity to go in and take advantage of whatever that opportunity is. You don't have to wait until you have enough cash. You don't have to scramble to go find debt that you might not be able to get access to. Because in hard times, you're often not going to have super easy access to debt. Or at least you'll have a lot more fees or hoops to jump through to get that debt. So you can't just pretend like you're always going to be able to get money when a great opportunity arises. And that's why it's important to keep cash reserves and continue to build cash reserves. Now, you don't need to get to Warren Buffett level to still have good opportunities by having a bunch of cash, but having some is imperative if you're trying to be nimble and flexible in an otherwise bad economic time when there's probably going to be a lot more opportunities than an otherwise good time. For example, if you have $100 worth of cash, that probably isn't enough to really get many opportunities. You probably can't even invest in many stocks. Unless, of course, you use M1 Finance using the link in the description below to open up an account, and you can actually start investing in fractional shares of companies. That is a fractional share of a share. So you can actually invest in a company like Amazon with $100 and get $100 worth of Amazon, rather than having to save up for the couple thousand or whatever their actual share price is now. You can actually just invest in a proportion based on the cash you have using a platform like M1 Finance. It's not the only one out there that offers fractional shares, but I just want to make sure you guys were aware. Definitely use my affiliate link in the description below to check them out. I have a whole series about M1 Finance if you're at all interested. So that's the central lesson here. Cash equals opportunities. And the more cash you have, the greater those opportunities are, but that goes both ways. The greater the opportunities are that you are foregoing at the moment, but the greater the opportunities there are on the other side as well that you would have access to because you have that cash ready to go. And I bet that this isn't the only opportunity that Berkshire Hathaway is going to have in the coming year. After all, this is only $4 billion in cash. They have $180 billion or so it's really a drop in the bucket for all intents and purposes. They could always sell off other assets if they think another one is good, though that would trigger some tax liabilities, but whatever. I doubt that this is going to be the last opportunity because they have this giant cash fortress. They can go jump on big opportunities as soon as they arise because they have that cash ready to go. So that's something we can definitely take away from this, and definitely something that can help you to become a better investor. Anyways, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. If you like this sort of content about the markets, investing, what successful investors are doing, about real estate investing, and really just anything about personal finance, definitely subscribe since I put out new videos every single week and I wouldn't want you to miss any updates. What do you guys think about this Dominion Energy deal? It didn't really go too much into the details, but it seems like kind of a weird deal from Dominion's perspective. I'd love to know the real motivations here for as to why they wanted to do the share buybacks, but I'd definitely love to get your comments below to see what your thoughts are and get a discussion going. But until next time, take care.